Welcome back to Switzer. With the pessimist seemingly in charge of the Australian market, is now the time to be looking offshore for value. The man who loves nothing more than an underpriced value stock has been looking cross borders and brings us his insight. Roger Montgomery from Montgomery Investments. What are you seeing overseas that's caught your attention?
Well, what's caught our attention is nothing to do with the market and where it is, but a lot to do with where we see opportunities within themes.
Okay.
So we're in the process of launching a global fund and a global long-short fund and a global long-only fund, and we've employed people out of New York who now have been working with us for quite some time, and we've taken our value investing process and applied it to global stocks, and then we've overlaid that on one of the funds with an opportunity to make profits from either declining share prices, broken business models, asymmetric risk, and so through that process, the stocks that we're going to talk about and the themes that we're going to talk about have come out. So one of those, and both of these businesses, here's the interesting thing, these businesses are businesses that have been collecting money from everyone watching, or at least 70% of the people watching this program have paid these businesses money without realising it. The first one, they're both, well, no, the first one's related to the ageing population to a certain degree, but also related to the greater access to healthcare in emerging markets. And the company, which I'm sure very few people have heard of, is called Essilor. Now, Essilor has a 39% global market share in the manufacture of eyeglass lenses, safety glass lenses, sunglass lenses and contact lenses. The sunglass lenses part is a smaller part of their business, but the corrective eyewear lenses, the ones that I'm wearing, they've got an enormous market share. Now here's the interesting. Is it an
American company? Or?
No, this is listed in France, listed in Europe. So this is a business. This is a business that has enormous what we call non-discretionary growth ahead of it. And I'll tell you why we think that. There are about 4.3 billion people on the planet that it's estimated require corrective eyewear. But only but only 1.3 billion people actually have access to corrective eyewear, and me being one of them. And about 70% of people over the age of 40 and 90% of people over the age of 70 require vision correction of some description or corrective eyewear.
So the demographic time bomb is working in your favour.
So, and a lot of the people that don't have access, so out of the 4.3 billion that need it, only 1.3 billion have it. So you've got, call it 3 billion people that are potential customers for Essilor.
If they have the income or the access to that product.
They need the access, and they're getting the access. And gradually, as the middle class in emerging markets rise, and the number of them rise, and their incomes rise. And remember, in Asia, you've got a young population. You know, you've got the average population in Southeast Asia is under 35, and so you've got enormous potential growth as well, just from the ageing of that population, and that's 20 years down the track.
People living longer in general, right?
So
they have to update. Even if you're over 90, you're probably going to have to get a new pair of specs every few years.
That's right. And I'm only talking about themes at the moment. We haven't got into any of the nitty-gritty in terms of the value of this business, but we think the business is trading at roughly its intrinsic value. And in Australia, trying to find a company that has that long-term, non-discretionary growth profile, really, you know, there might be CSL, Cochlear, you know, they're the sorts of businesses in Australia, and there are businesses in Australia that have that potential, but we're finding lots more.
How does it compare on a PE ratio compared to something like
PE is in the low teens.
And why is that? Is it because the Europeans see it as an established business and they don't think it's a growth stock, or what, why the disconnect?
Well, I think the issue is in Australia we've got franking credits, and we've also got high dividend yielding companies, and so in a world where we've had helicopter money and that's forced people out of their term deposits and out of their savings into riskier products because interest rates have come down, and in the US, for example, we've got ZIRP, you know, zero interest rate policy, and so in Australia the attraction of high dividend dividend yields has pushed up prices in stocks. So if we look at, let's break down the makeup of the Australian stock market's performance over the last 5 years. The market's gone up about, or the price market, not the accumulation index, but the price has gone up about 26%, 23 or 26% or thereabouts. But earnings growth over the last 5 years only been 5.5%.
Right.
So that expansion, therefore about 20% or 19% of the 23 or 24% of the market's expansion is due just to PE expansion. The chase for yield has pushed prices up. Overseas, in some markets and some stocks, we don't see that as much. Now, another one which is an entirely different theme, another company that everyone has probably paid that's watching this program, is a company called Qualcomm. Now, you might have, that might ring a bell. It might ring a bell, but what people probably don't know is that Qualcomm is a business that owns the patents to 3G and 4G telecommunication networks globally.
You would think that would be a lucrative business.
That's not bad. And when you go to a cafe and it says free Wi-Fi here, they own Wi-Fi.
Right.
So every time...
Which is an Australian invention.
Previously, correct. Right. So every time a phone is manufactured and the chip is put in to allow that phone to access the 3G or the 4G network, they receive a royalty.
Right. Okay.
Now, as a result of that arrangement, they have a market cap of about $113 billion. They have $29 billion in the bank.
Okay. They have in cash. They're just sitting on cash.
Just sitting in cash.
So where is this company based?
This company's based in the United States.
Okay.
Its potential growth opportunity again is enormous. The way we talk about it at the office, and Andy Macken, who's the analyst that covered this stock, he said this is a business that's a little bit like when it's almost like it owns the English language. Okay. And every time someone learns to speak English, they get a fee.
But is it potentially open to disruption? Could the fact that they own they own the 3G and 4G patents and they own Wi-Fi, if that is superseded by some new technology, does that destroy their entire valuation?
Well, I'm not sure that if you've got $29 billion, you can't research,
or buy the other
you can't spend the money on acquiring the new technology, or you can't spend some money on researching and developing it yourself. So there are a lot of themes like that, and some other and some great companies within those themes. And another one that I think is absolutely brilliant is this idea of cybersecurity. So more and more of our personal data is being recorded. People are buying iWatches, and what they don't realise, of course, is that every bit of biometric data is being recorded and tracked on there. And in fact, Apple's lodged some patents where they believe that a combination of biometric data will allow them to determine whether you're happy, sad or angry. Combine that with the AAMI app, the Safe Driver app, which is actually recording whether you're hard accelerating or hard braking, and whether you're talking on the phone while you're driving. So you're on the phone driving and you're angry and you braked really hard or accelerated really hard and then you had an accident.
Legal issues.
Pretty much you're guilty of driving badly.
Can I pull it back one level? When you were coming to determine what stocks you were going to investigate, did you go sector specific and say let's have a look and let's put them through our model and see what happens? So how did you come to it?
Well, viewers of the show would know that we rank companies from A1 down to C5 in Australia. We have a similar process, a quantitative process for determining quality first.
And you've started with large companies? Is that how you first started putting them in?
Market capitalisation doesn't. We're so small that we can invest in very, very small international companies with even faster growth prospects. But what we do is we use a quantitative process, an algorithm, if you like, and that's the first part of the process that determines the companies that are quality. The quality is high enough that we can even bother looking at them, and then we rank them by quality. And we start at the top, literally, and then go through those with a fine-tooth comb, build out the models if something looks interesting, and then value those companies. That's how they're going to get into the Montgomery Global Fund and the global, what's called the Montica Global Fund.
Roger, we could talk all night, but we're going to have to leave it there. Thank you for coming on the show.
Thanks.
And that is it for this episode of Switzer. Don't forget Best of Switzer over the weekend. We'll see you next week.